or out of the money puts, and you start seeing different values of volatilities for those strikes, that's what we kind of depict as traders and call it skew. Skew is basically difference. All right. So, Matt, what I'm going to do, and I'm going to plant this seed here. And I know that you grabbed a bunch of screenshots, and I will tee it up for you, sir. But here's where I want to take it first. Okay. So I'm going to share a few screenshots, zoom into them, and kind of talk about what's normal, what's expected, what happens, and how we should be thinking about reading the option chain. If you don't have tools like the Bloomberg terminal, if you don't have tools like Livevol Pro, if you're just using Fidelity tools, we're gonna show you a lot of visuals today that are non-Fidelity resources, but we're also going to tell you, right? I mean, effectively, what are you doing? You're looking at an options chain and you're looking at those differences. So at the money volatility, straight down the middle, that's where the underlying is currently trading. Y-axis is implied volatility, also known as sigma in the industry. Bottom, of course, is relative strikes. 0 for a stock all the way on the left. And of course, closer to 0 out of the money puts. And the further away from at the money you go effectively to infinity, hypothetically speaking, are out of the money calls, right? Or at the very least, infinity in a sense, up to the strikes, up to the strike availability. So wherever those strikes end for calls versus where those strikes end for puts. So this is known as the volatility smile. When you're looking at the y-axis and you're saying, if I go equidistant in percentage terms or in dollar terms away from at the money, my calls and puts are going to be equally priced in vol terms. This sort of condition does exist, but it's not going to be the most observed. Why? Because this condition kind of reminds us, right? Or looks elusively as if the markets are normally distributed, right? So if implied volatility, I'm looking at the S&P right now, if spiders are trading at 14.5 vol, it's basically mathematically saying what? It's saying 1 year from today, based on the way the S&P 500 options for 30-day expiration are currently trading, S&P is going to be up or down 14.5% 2/3 of the time. You double that, 29%, 95% of the time. Triple that for 99% of the time. That's a normal distribution, right? Where the market participants' engagement and probability of the markets going higher and what participants do when markets go higher versus when markets go lower and what participants do when markets go lower is equal, or it's the same. It could not be further from the truth, though, because market participants trade with a bias. And what we're trying to do is figure out what their bias currently is and if there is a way for us to take advantage of that. So forward skew, positive skew, or call skew is a circumstance where calls equidistant to puts are more expensive in vol terms. This happens a lot in single stocks that are exhibiting kind of extraordinary enthusiasm, euphoria, speculative activity on upside potential continuation, right? We've seen plenty of this, and we'll likely look at some examples of even current conditions where upside calls are substantially more expensive than downside puts. This is more of a realistic view of how things normally work, right? With a bias. Your job is to figure out what that bias is. The reverse skew or the smirk. Oh, by the way, learning all sorts of things here today, right? What is this also known as? So it's forward skew, positive skew, also known as the Nike swoosh, right? This kind of looks like that. This is the opposite. The reverse skew, also known as negative skew, also known as the smirk, where out of the money puts are more expensive than out of the money calls. Think about all those markets where market participants are substantially more afraid of downside movement in securities that they're potentially long, right? Or downside continuation, or markets where commodity markets, for example, right? Where people are hedging using derivative products because they're producers or farmers. So we're going to look at some interesting things. Again, forward skew, positive skew, swoosh, reverse skew, negative skew, smirk. Those are the more realistic types of things that we see. Now, the way they're depicted on these charts are very exaggerated, right? You normally don't expect the curvilinear nature of these slopes to be the way they're depicted here. And we're going to show you real world examples of what they look like. Now, Matt, again, I'm setting this up for you, sir, so you can really take it home. I showed a very similar chart to this in the volatility primer yesterday using the Bloomberg terminal. And what I am depicting here, folks, is the at the money volatility for the Magnificent Seven: Tesla, Alphabet, Microsoft, Metaverse, Amazon, Nvidia, and Apple, versus the implied volatility of at the money options for the S&P 500, SPX. The SPX vol right now, as I mentioned, 14.5, 1468, just depending on where you're catching and what the market is doing in this moment in time. So let's call it just a little shy of 15. Where is everything else, and what is everything else doing? Remember, this is at the money vol. Tesla, a couple of weeks ago, was above 70 after earnings came down to 50. Nvidia yesterday had a 47 handle on it. Today, massive expansion in vol, up to 69 almost. 10% expansion in volatility in the last 2 days based on what's been going on in the stock. Options are becoming substantially more expensive. What else is rising? Microsoft's volatility is expanding. Amazon's volatility is expanding. Alphabet was roughly in the mid 30s, mid to high 30s, came down after earnings to 26. Apple at 28, the cheapest, but implied vols, or the cost of their options of puts and calls at the money. In all of these cases, even after the contraction post the earnings events in the two of these, are still double, triple, or quadruple what it is for the S&P 500. Okay? So if you're a trader of these options, you understand that the natural expectation for movement based on the way option markets are currently trading and traders are positioned, they're expecting significantly more volatility out of these stocks than they do out of the S&P. Remember the rule of 16? I'm not going to go into geeky math here, but just remember in your pocket, rule of 16. If implied volatility is 16% annualized, that is de-annualized to a one-day move of 1% 2/3 of the time. If it's 32, it's expected to move up or down 2%. So forth and so on. Okay. Matt, by the way, I was just talking about implied volatility sub 10, right? Well, if it was at 8, the expectation of movement would be 0.5% up or down range wise for a security. So Matt, over to you, sir. I've been talking for some time here. I think let's show people what skew is. How does it look? And the very important question and point of not only what can we learn by looking at these fancy charts, but if you were a trader of these options, why is it important for you to figure this out? How is it going to be impacting your trade, right? Matt, please take it away, sir.
Yeah, so I think I'll start with a basic example here. We'll just look at SPY. And the other thing I just wanted to comment on, really quickly, if we were looking at a perfectly efficient market where there were no expectations, where people didn't have a directional fear, what we in theory should see, and that very important for you to understand, it's in theory, right, is that we should see across strikes implied volatilities be equal. But we never, ever see that. That's not been the case. And especially after 1987, when we had the famous stock market crash, especially on the indices, what we see is what we're currently looking at right here today. So let me just go out there and show everybody what we're actually trying to observe here. Let me restructure this here for just a moment. And on the left-hand side, I have an option chain. We're looking at SPY in both cases. We're going to have calls on the left and then just puts on the right. And what we'll see is if we were to look at the same strike here, as we're going to at the money, and I'm using 545, it has continuously been moving up. They need to get Constantine on CNBC because it was just in a straight uptrend the entire time he was talking there for the first 15 minutes. But when we're looking at these, we'll notice that the calls right now are actually more expensive than the puts. Puts are trading for just under $7. Calls are trading for $9.30 approximately. Now, some of this is a byproduct of the interest rate environment that we're in, which is why when we're truly trying to analyze skew, the easiest way for us to identify if this is existing or not is to start to move away from the at the money. And I'm going to do that in this case. We're using the next monthly cycle, August 16th in both instances here. And on the call side, what we're going to do is we're going to start gradually going up from 545, and we're going to raise that strike to, we'll use 10 points out of the money, 555. And what we'll notice here is that the calls in that case are trading for 430 by 432 with an implied volatility of 13.84. And this is why we usually like to look at it in implied volatility terms, because it's giving us a unified or a standardized way to compare the implied volatility for each and every individual contract. Now, if we were to do the exact same exercise and we were to go out and look at the 10-point out of the money puts that are also trading at 535, not also trading, but trading 10 points away from the current at the money strike. Well, when we go and observe those, what are we actually going to see in that particular case? Well, we're looking at a situation where it's 376 by 378. So we're getting a lot closer, right? Remember that the difference here when we were looking at the calls, it was about $3 between at the money. When we start to go to the 535, well, now it's significantly closer. Calls are still a little bit more expensive, but we're actually getting closer. If we were to continue to go out here, and I'm going to change this up a little bit, we'll go to the 535s. We'll hit enter. Or I'm sorry, I'm using the wrong thing. We want to go to the 565s on the call side. And then we want to go to the 525s on the put side. We'll give that a minute to update. And when we do that, we'll notice that as we start to get further and further away from the money, first of all, notice what's happening to the implied volatility values here. The difference is getting larger there between puts and calls. And now we're actually in a situation where it is now flipped over, and the 20-point out of the money puts are now more expensive than the 20-point out of the money calls. And notice we've even been moving up. So now we're at 546. So in theory, right, the 546, now that we're closer to 565 than we are from 525, it should be even less this way. but it's not, right? Puts are actually getting more expensive. So this is that idea of the skew that's kicking in here, which is especially as we get further and further out of the money in the indices, especially, we start to see that implied volatility raise further and further. And the main reason behind this is there is a demand function more so on the indices than some individual stocks, and the correlation between the components of the indices and the actual index itself that's been coming into a focus here as we're starting to diverge, and correlation has become a hot topic amongst analysts. But what we're really seeing here is a function of people are less in demand for those out of the money options, even though there may be some speculation that's going on. The vast majority, especially of institutional investors, are not so much worried about, well, what if we go up 2% today? Why might that be? And the reason why is because the majority of the world is long securities. They want the market to go up because historically that's what it's done over a long-term basis. What they're afraid of and where the fear is what if we have the disaster collapse scenario? And we just saw yesterday what that can look like, a 2% down day for the first time in quite some time. And it hurt. I think we were down, I want to say 11 or 12 points yesterday on SPY, something to that effect.
Yeah, it
And
should have been 12 plus. I
12,
think SPX was down 128 on the close.
there you go. So the point here being, though it seems like 20 points is a long ways away and 22 days isn't that much time, we went down 12 points in one day. So 20 points is right there knocking on the door at all times, but especially when we've actually seen a scenario where there's been some heightened volatility. So this is the first way to just I wanted to start off by showing everybody how can we actually find and observe, does it exist, does it not exist?
Matt, really quickly, a very important point. I think, you've been definitely showcasing this, in your sessions with Andrew. In a high interest rate environment that we're in right now, calls are always going to be more expensive than puts at the money. Just from the perspective of what happens, right? When you can exhibit a bullish view for a substantially less capital commitment. So row and interest rates for calls is positive and it's negative for puts. So the idea here is that if interest rates were zero and we were looking at this board, if you went 10 points out of the money on each side, even though volatilities are telling us, right, that there is still volatility skew, but calls are more expensive than puts 10 points away, very likely the reason why they're more expensive, right, is not because of the implied volatility differential or how low it is, but because of this natural positive drift to calls due to interest rates. Okay. But Matt is exhibiting, strikes that are substantially below. So as you start expanding out, think about 5% out of the money, 10% out of the money, 15, 20. That's where you really start kicking in and going. People are saying, I'm not really worried about a 5-10% pullback. Those are normal, but I want to protect against disaster, right? Like if something really was to happen, all of a sudden the market was to go down 20% in a week. I wonder what do those puts cost, right? Matt, please take it away. And to your point, as we slide down in the index, implied volatilities for puts rise. As we slide up in the index to upside calls, implied volatilities contract, which is another thought that we constantly talk to. Matt and I have definitely discussed this in sessions before, where if markets go down, they go down to higher implied volatility levels. So it's not just driven by the fact that there's more fear out there, more demand for puts, therefore implied volatility is rising. It is also rising because the at the money strike is sliding towards a higher current implied volatility as it exists on the board. Okay. Matt, back to you, sir.
And just to highlight what he's saying there. So, and this is why, especially in an interest rate environment, because that's an excellent point, and I tried to clarify that, but I think you did a much better job explaining it than I did initially, which is in the where there's a carry on the actual trade. It's always going to be that at the money calls are more expensive, as he said. But this is why it's much easier for us to think in implied volatility terms, because when we go and look at the 545 call, or let's use the 546 now, because again, Constantine came on and we caught some green bars. I don't know how he's doing it, but got to figure that out someday. When we look at the 546 calls, the IV percentage here is 14.95. When we look at the 546 puts, it's 14.80. So the calls are actually slightly, I mean, that's more or less flat, but slightly higher in implied vol terms. But then notice as we go on the call side, one out of the money, 14.82, and then one down on the put side, puts immediately start trading with a higher implied volatility. And this is going to exacerbate as we get further and further away because implied vols are going up and they're actually going down on the call side. And that's what we're talking about. That's the skew, the difference between the implied volatility actual values there. That's literally what we mean when we're talking about skew. So why is this important? I think the very easy way to think about this is, well, what if we wanted to take a speculative side here? When we're thinking about that 16% rule, it's not telling us about the actual directional proclivity for the market to move. It's just talking about the magnitude of what the move is expected to be. So what if we wanted to be a speculator? And we're right here at 546. So now's a perfect time to do it. If we wanted to go out there and place a bet on the market going up and we wanted to go out of the money, and let's just say we went 10 points to make the math kind of easy here, well, that would cost us $4.13 on the call side. On the put side, if we wanted to do the same thing, and we'll go to the 536, notice that it's a little bit cheaper on the put side right now. And again, some of this is the interest rate that's affecting it because the implied volatility is still higher. But what we'll notice here, and it becomes way more obvious if we add in a second leg, which is, well, what if we wanted to buy the put spread? So what if we wanted to sell another leg? And I'll just go 5 points down here. So I'll use a 531. I'm sorry. We want to sell the 531. So we're still bearish in this scenario. What if we wanted to go 5 points up and let's say we wanted to sell the 561? What would the respective debits end up being? Notice that the midpoint on this one, they're both 5 point spreads. They're both equally distant away from where we're currently at. But notice that the put spread is $1.03 midpoint. And then the call spread, the bullish version, is $1.57. Why is that? Well, even though we're buying equally distant and on the call side, it was actually, just slightly more expensive. Well, when we actually go and we're selling the 561, notice that we're getting $2.51 here. Well, when we go and sell the 531, we're actually getting 295 and 297, relatively more expensive. So when we're going in there and doing the spread version of the trade, we're getting incrementally more dollars here represented in the further out of the money, which is why it's making this version of the trade cheaper. And we can do the exact same thing with the opposite version of the trade, which is, well, what if we wanted to go in there and do the opposite versions where we're selling to open the bullish put version, we're doing the bearish call spread. Well, now we're going to see the exact opposite condition, which is the bear call spread. We're getting $1.62 on a 5 point spread, whereas in the bull put version, we're only getting 98.5, 99 cents. So what is it effectively doing here? It's punishing one side of the trade, or it's making it cheaper to take one side of the trade. Constantine, I saw you come off mute here, so I want to give you a chance to jump in.
Yeah, Matt, I think this is a phenomenal example, and the way you have it laid out and structured is great because what is this trade called if you combine all four legs together? So if I'm selling the bull put spread, the bull put vertical, 536, 531, 5 points wide for a buck. And I'm selling the bear call vertical, 556 short, 561 long. This is called an iron condor, right? And for a 5 point wide spread, I'm bringing in a credit of a $2.60 between the two of them. So in this environment, as it exists right now, with the current bid up and vol, due to the drawdown dynamics that we've seen over the past week, you can put on this trade 10 points out of the money on both sides and have a 1-for-1 risk reward trade in an iron condor. This is a wild thing. You don't normally see that. You normally see like a 2 risk to 1 reward type of a payout. And Matt, again, we keep saying, why is it important? It's important because if you evaluate a rising vol environment, you can use it opportunistically to say the odds of the probability of my potential outcomes of being a premium seller increase substantially. I can go further away from the money, increase my probability of success, and bring in substantially more premium in credit for premium selling strategies. Oh, by the way, Matt, what if you're a buyer of vol? Imagine if you were, by the way, I took the screenshot a little bit earlier today when the markets were kind of flat. Like, there were up 10, 15, 17 points. And Matt has it depicted on the board right now. What are the at the money calls doing? How much are they up? Market is up almost 1%. Calls are up earlier today, they were up 3, 4, 5%. Now that the market rallied to up 1%, they're up 20%. If these volatilities were not at 14 or 15 to start off, but they were at 9 or 10, these contracts would be up triple that on a 1% move. So if you're a buyer of calls because you're saying, I think the market's going to turn around, it's gone too far too fast, and you're not paying attention to the volatility space, and you're just a buyer of calls because you're expecting to make 1x, 2x, 3x, 4x your money very quickly and get out, you're in for a surprise. Why? Because when markets rally, volatility contracts. If you're a buyer of puts, like in our VIX session a couple of days ago, right? We said when the S&P 500 was trading, I think at the time, 55.70 or so, we're looking at the money puts for August 23rd expiration are saying it's worth $70. They're worth $70. 1.25% of the value of the index. Well, yesterday in a single day, we're down $130. So not only you're getting paid massively because you got the direction correct on buying a put, but implied volatility expanded. So it made those puts more expensive and it was a tailwind for you. Matt, back to you. I mean, again, spiders, indices, broad-based indices are generally going to have this sort of a dynamic to them, right? So if you look at the NASDAQ, they're likely going to look similar. The Russell flips back and forth once in a while, and I'm sure Matt is going to bring that in as an example.
Yeah, and that's a great place to kind of start here. Just to summarize this point, basically, if you're taking the side of the skew, then those are going to be, if you're selling spreads, then it's going to be what we would say trading rich, which is why bear call spreads, when there's put skew, they trade rich. And all we mean by that is you're getting more credit than you would if you sold the put side. And then vice versa. If you're buying it, it's going to be beneficial if you're doing it on the put side versus the call side because it's going to be cheaper for you to do so. But yeah, let's talk about how can we visualize this over time and the movement of the two. And we really needed to get a firm grasp on this first before I start bringing in some of these screenshots. And all of the next ones I'm going to show here are from LiveVol Pro. And the first one I'll show here is just kind of what we were looking at just on a slightly longer term to expiration basis. So we're looking at 90 days to expiration instead of 22 in the example that we were just looking at. But effectively, what this is going to do for us is show us a couple of things. So we have the put side. That's our light blue line here. And you can see pretty much in every single scenario, I don't think there's really a spot where the out of the money put is going to be less than the call. But mainly what I'm trying to focus on up here is basically the netting of the two. So we're looking at a 90-day to expiration put. That's the 25 delta, so out of the money. We're doing the same thing on the call side. And then what are we doing? We're dividing it by the at the money call and its implied volatility. And remember, we could use the call or the put there. It doesn't really matter because it should be roughly the same implied volatility. And that's just going to give us the ability to kind of standardize the line and watch it ebb and flow. So what's kind of interesting about what we've been in for a lot of the beginning part of the year, we were in a slightly higher um, netted out environment, and then we had been gradually coming down. So let's think about what's having to happen there. So if this number is higher, we want a higher implied volatility on the put side, or I guess we could look at it from the perspective of a lower implied volatility on the call side. Usually they move somewhat in tandem, right? Where if one is happening, then the other is affected, so on and so forth. But what we've been seeing since basically April is a reversal of this. And now we're actually seeing it starting to trend back in the other direction when we're looking at what the differences in implied volatility are. And as of today, I mean, this is getting close. I know we're looking at maybe a couple days ago where it was slightly higher. But as of today, this is really going back to the beginning of the year, right where we were at that time, where the put implied volatilities, when netting them out with the call side, is getting back to that point. I'm showing 0.34 level when it had been much lower for the majority of the year. Now, it's not always going to be this case. And this is kind of what Constantine he was given a sneak preview here, what we're going to talk about in IWM. For anybody that's not aware, IWM is it tracks an index. It tracks the Russell 2000 though, instead of the S&P 500. It's a much smaller. I mean, it's the small cap index, right? It tracks a much smaller market capitalization than the S&P 500, and for this reason, it tends to have a higher notional volatility. So if you were just to go out and look at the IV 30s for SPY versus IWM, it's usually higher on a consistent basis, right? And that's just representing the ability for it to move. For example, look at it today. Go look at the percentage if you have your Fidelity.com Active Trader Pro up, and look at what IWM is up in comparison to NASDAQ, so QQQ or SPY. And we actually saw right at the end of last year, and then we kind of had a couple retests recently here, especially on that breakout that we had in IWM, where what was actually happening, puts were probably remaining somewhat similar, but the call side of the equation, we're seeing skyrocketing implied volatility. And what was that? Well, that's people stepping in to buy calls because the thing was up, what, 4% in a very short order, maybe even more than that. So when you saw that happening, you saw people come in and say, okay, well, I need to buy call if I'm speculating, or they could have been the opposite condition as well, which is what about people that are, short IWM because it's been a massive underperformer? Are they stepping in to maybe protect themselves just like a lot of institutions do on the put side for the broader S&P 500 and NASDAQ 100?
Man,
So, and this is, yeah, go ahead.
what was the trade, right, in the Russell 2000 that was literally written in thousands of newsletters? I've personally seen hundreds of times, right, so far this year. The easiest trade of them all. Russell 2000 rallies, sell call spreads. Why? Because each time it rallies, it crashes right back down. It crashes down to support. You still have those call spreads that are far out of the money. Keep them on because they're still making coin, right? They're still printing. But as it gets close to support, sell bull put spreads. So basically legging into condors back and forth. Why? Because the security was range bound for such a long period of time. What's the danger of that? The danger of that is that when it finally breaks out, what happens to all those call sellers naked? What happens to all those call spread sellers, right? Not only that there's brand new demand for buying of calls because sentiment has changed, but all of those short the calls, collecting premium all this time, thinking it was free money, having to force close them, right? Having to buy to close those calls. That creates massive demand for call options. And Matt, the important part here, and I was alluding to this point in my volatility primer yesterday, is that when implied volatility is this high, notice it's high both for puts and the calls. The calls are just more expensive, right? Almost to a certain degree than the calls are, or than the puts in IWM. If you are engaging in optionality, you are trading options in the rut, or you're trading options in IWM, understand you're a buyer of very high vol. And what that means to me as a trader, if I have to buy high volatility, I might as well sell some as well, right? So doing multi-legs, doing bull call spreads, bull call butterflies, broken wing butterflies, bull call condors, that sort of thing. Take advantage of that upside skew. It's going to slow the trade down, sure. If the Russell is up two and a quarter, 2.5% a day, you wish you would have just bought calls. But if you are wrong and Russell kind of stabilizes or chops around, goes sideways, pulls back a little bit, it's going to be a much more palatable trade to host in your account, because likely in that scenario, volatility will shrink and contract. And if you're just long a bunch of Vega on top of your long delta and the security is not doing what you want, vol is contracting, you're getting hurt twice. Okay. So Matt, I just wanted to point that out. That's very, very important.
It is, and this is effectively the same chart. I just want to show you that it can actually go.
That was something that I definitely did not learn in the book, right? Had to see it for myself. And from what I understand, a lot of brokers out there that have been in the business for decades, having options on futures and futures trading ability for clients, they didn't know, meaning they didn't have risk tolerances or parameters for negative values on commodities, right? And have to eat a lot of losses for clients being off sides. So yeah, we have to be careful, but theoretically, right? They have a floor. They have kind of an intrinsic value, if you will, of sorts.
Exactly, and that's effectively what we're seeing in this version of the chart. So think about what's happening now. Except for in a couple of instances, the vast majority of time, where are we spending when we do the same calculation here, which is take the put volatility, subtract the call volatility, and divide it by the call volatility. Well, now the reason why these values are negative is because the call volatility is higher than the put side. So the exact same thing is occurring as what we saw in S&P 500, NASDAQ, in most instances on IWM. It's just on the opposite side of the option chain. The calls are more expensive. So all those same things that we're looking at, where we're looking at, what type of spread is trading richer? Well, it's going to flip around because the call is existing on the opposite side of the chain. So gold is a really good example of that. We have this one as well for USO, and this one is a little bit different because USO, even though it's tracking oil is a commodity, we see on this particular one that the more normal condition in comparison, when I say more normal, I mean in the sense of thinking about it from an index perspective, it comes back into line, but we certainly see moments in time, late 2023, a couple months ago, where the opposite condition is occurring. And then the other one I just want to highlight here for a second. Give me just one moment here because I need to pull it up because I lost it. But can we see this on an individual stock as well? And the answer is absolutely we can. So I'm going to use one that I'm sure most people in this room are familiar with because it's been kind of the leading story, I would say, for the market. If you had to pick one individual stock and characterize 2023 and the start off of this year, I would probably say this is the one most people would pick. And notice what's happening here. Before in early 2023, it was, bottoming out here in late October of 2022. The normal condition pretty much was in place. We saw at the beginning of 2023, right around that first earnings report, it started to go the other way, but it actually spent some legitimate time here in 2023 and also this year's kind of when it went into, I'm not trying to disrespect 2023 because it was an amazing year that year as well, but I would argue it went into hyperdrive here in the earlier part of the year, especially in terms of speculation. And what happened was we spent a couple months there where calls had a higher implied volatility than puts. And remember, this is not because there was a fear of the market going down. Let's just remind anybody that maybe isn't familiar with that chart. It was the opposite condition. It was the market was taking off. So this is what was going on with NVIDIA at the time, and hopefully my implied volatility is going to cooperate with me here. Okay, beautiful. It is. We're looking at the same thing. And you can see these moments in time where the implied volatility itself is expanding in the orange line. And it's because the stock is actually going up. And this is the kind of the hyperdrive moment that I was talking about, where we had this earnings, it blasted higher, and then it gapped higher again a few days later. And then it went from 100 to 140 in basically no time, right? Didn't stay there for very long. And, it's trying to fight back as we speak. But in that period of time, we actually saw a lot of it skew on the call side. Now, there's one other aspect of this that I want to talk about because we've been really focused on the up and down, the option chain, but there's also the idea of skew when it comes to across time frames. And we have NVIDIA, we could use that as an example, but instead of that one, I'll use one that is coming up pretty shortly here. And let's go to the weekly. And what I'll do here is I'll use the August 2nd, and I'll just go out even 2 weeks, and I'll just keep it on the call side for a moment here. And the reason why is because, well, now we can start to do the same concept. So we're thinking about, well, what are the implied volatility values themselves? So forget about prices for a second. We'll come back to that. But what is the implied volatility itself in comparison to this expiration to the one that's just 2 weeks out? And what you'll notice here is when we go to the 425 and we look at that call, it's 44, which is the 425 here is only 32. So there's a 12-point IV difference between those two dates. We're getting 3 times as many days is the option. And this is really where it comes into effect here. We're paying 1145, 1165 for this option. We go to the same one, we're getting 3 times as much time. The option is not 3 times more expensive. It's only
So folks, this is so important. Which one are you buying? Let's say that you want to be bullish Microsoft, right?
yes.
Let's say you want to be bullish Microsoft. Do you just fall into, the Redditor dream and the FinTwit dream of, hey, short-term expirations have the most gamma, and it's all about let's trade the 0 DTE? Or do you turn your thinking hat, you put on your thinking hat and you say, I can get 3 times the amount of time for $2 extra? It should be a no-brainer, right? That you go further out in time. Matt, I mean, this is not even like a crazy example. You always think about these things in terms of practical advice. Hey, what's going on right now at this moment in time? Always compare and contrast. Look at the board, study the board, look at the numbers, evaluate the risk reward opportunity probability. Don't just be like, hey, I'm a strategy first trader and I always go to the front month. Open them up, right? And compare them. Well, how are they trading and why it matters? Matt, back over to you. I do have a couple of additional screenshots to share, by the way. I'm curious, what else do you have in store here today, sir? Microsoft is a great example, given the fact that it's got both earnings and a dividend coming up here.
Yeah, I mean, I'll actually pause there because I feel like I've taken a large chunk of the back. I want to make sure that you're getting your screenshots in. So I'll unless you're not ready to bring them up,
No, no, I am, Matt.
I'll let you go for it
I'll
then.
gladly do so. I'll share Active Trader Pro and I'll just quickly talk about the Skew index from the CBOE and some of the competitors that have come out recently or lately. If you type in .skew, understand that it only gets one reading a day. It's not a live feed, right? Like volatility, for example, is. But so we have to look at it kind of in a line type format. But you can see that it's moving around all over the place. I'm going to go out to a long-term chart here. I'm going to go to 10 years. Notice that there were times when Skew was very close to 100 handle. There were times when Skew was at 170. There are plenty of times when it's oscillating between like 130 and 150, like it has been in the year of 2024 and late 2023. Now, you might be saying, what in the world is this thing? How should I read it? Right? Look, the way you read it, folks, is in the following fashion. And I'm going to bring in my screenshots at the moment and share with you the screenshot from the SIBO. So remember how we talked about normal distributions, right? Where mean, median, and mode is all the same. Symmetrical distribution of 50% on either side, normally distributed, truthfully normally distributed curve, right? In reality, though, what is the likelihood? Well, we're studying positive, negative skewness. So already it's not normally distributed, very likely. And on top of that, we're now considering, is there kurtosis, right? Is it leptokurtic, mesokurtic? How fat or thin the tails are, so forth and so on. So that's what this session was all about. So how do you read the skew index from the SIBO? Well, if it has a value of 100, then basically the 30-day log normal returns, talking about the distribution, right, are truly very close to normal. Why? Because 95% of occurrences have 2.5% tails. Two standard deviations is 95% of occurrences, 2.5% tails on either side, approximately, right? Three standard deviations, 15 basis point tails. So take the vol, triple it, look at that range, 15 basis point tails. If you have that reading of skew at 145, what that means is that you have massively leptokurtically distributed structure where the tail is really fat, okay, on one side. This could be, by the way, driven by both calls and puts, like we discussed. It just depends, right, which side is driving it. In the S&P 500, it could be driven by calls and puts, but most of the time it is driven by put values. Why? Because puts are more expensive in volatility terms than calls. So in that circumstance of 145 value, and by the way, this screenshot I've had for a few years, at the time, skew index was never higher than 145. Okay, based on the work that they have been doing. Remember the chart that I just showed. We've recently been on this particular index as high as 170 in the summer months of 2024. What does that mean? At this point in time, way out of the money puts are substantially more expensive than way out of the money calls, right? And that's an important observation when you're trading, when you're trying to hedge. If you're panicking, right, and you're saying, I don't know what to do, look at this board and say, hey, how cheap or expensive on the relative basis are calls and puts? The lower this number goes, the more equally priced they are, going far out of the money, right? Crash protection. The higher this value is, the more expensive in the S&P 500 the puts are. Matt, we're right at time. I'm not surprised at all that time flew by. But I'll leave on this screenshot and leave the kind words, last words to you, sir. Matt
Yeah,
earlier made a point about the 1987 crash, and even though it's not really fair to compare today's environment to 1987 because of the proliferation of derivative products and the way they're traded today, barriers to entry effectively are zero, and if you have a $500 account, you can trade whatever you want effectively, right? But it used to be a smile in the S&P 500 prior to 1987. And then everybody said, oh my God, the market can go down 30% in a single day back then. But there are these products that could have protected me dollar for dollar, effectively insurance policies, right? On my holdings. I'm going to definitely take out an insurance policy next time. What does that create? That creates substantially higher demand for puts in the index, and it created this, what we know as the smirk, right? As the put skew or negative skew to the S&P since 1987. Matt, last words to you, sir.
I think the takeaway, and I know we didn't focus a
Am I
lot
am I
on.
not sharing the, by the way, screenshot here? I should be sharing it, huh? Matt, last words to you, but while
There
I'm
it is.
sharing this thing, I was like, I'm talking to it, but I wasn't sharing it. I apologize.
There you go. So basically, I know we didn't focus a lot on individual strategies. I tried to show you the idea of speculating with put versus call, doing bull put spread versus bear call spread when you have skew in there, and how it affects what the difference is. What I will say is the main takeaway for identifying skew is, first of all, to understand, is there some kind of demand function, and is that representative of some kind of leaning from market participants? That's one way to observe that. But I think the more important way to analyze this, and then maybe not use it for predictive reasons, but for structure reasons. And what I mean by that is, what kind of structures or option strategies do I want to employ when I'm identifying this type of skew? Is there even skew? Is there the opposite version of skew? Is one strategy better than another? If I'm usually and we find a lot of people that are like this, and I get it. I usually do, short puts, or I buy puts, or I do vertical spreads. Great, that's fine. But are we currently in a condition where that's the most favorable to your strategy? Or is there an adjustment or a slightly different variation of the strategy that you want to use that is more beneficial due to the structural nature of how the options chain and volatilities are set up? So that's the main takeaway here, right? Which is, do um, my strategies or whatever I'm planning to use, does that align with what the market is currently, just demonstrating for me, and do I want to make some sort of adjustment? So that's kind of the final point that I wanted to make here. Constantine, unless you had anything else, we'll probably wrap it there.
Yeah, Matt, we did pretty good on time today. Thank you everybody for the kind comments. Jay, Stewart, as always, absolutely. I'm glad you're finding some of those guys on Twitter like Jam and Michael helpful. I've been sharing Matt. I know Matt is a fan of Chris Sidiel and Chris Abdulmazik. Those guys are also, just very, very strong minds in this space, and clearly, run their own funds with tail hedges and vol structures. So they know, and not only know but practice a lot more than we do. We talk a lot, right? But don't really practice as much. Those guys have substantially more experience than us. So um definitely follow those guys. No doubt about it. Let's see. Matt, this would be the last thing that I'm going to focus on. Kind of came to me, by the way, it had nothing to do with Constantine's positioning, with what the market is doing. Trust me, I told you guys and gals before that I will never be swinging the market one way or the other, regardless of how large my ego might be. My account size is never going to be important enough. But I was thinking, CrowdStrike, had an interesting structure. It had horizontal skew and vertical skew due to its nasty um, news cycle, right? Based on what it kind of what transpired. But and I'm gonna find out together with you right now if it still exists or it doesn't. And this is not a solicitation or recommendation of individual stock, but I was looking at this a couple of days ago, and I was saying to myself, August versus post earnings expiry, and it has come down, folks. It's not there anymore. That's how quick the market is, right? In terms of repricing things. This is phenomenal, and very, very interesting, actually. So what I was seeing there on the first day of the huge drawdown was that August expiration front month, which were like 25 days on Friday last week. Yeah, it was 25 days to expiry. These front month calls and puts were trading for 4 absolute implied vols higher than the post expiration, post earnings announcement calls and puts. So normally you see that distribution, right? That horizontal distribution be there, horizontal skew be there of the pre and post. And then, like comparing August to September or August to October, it's going to come back down, right, to its normal, if you will. So if I scroll down to September, what are those balls? Those balls are basically par, right? 240 strikes are 53 and a half. 240 strikes here are 54, 4. So 2 absolute points. So there's a little tiny skew of the exactly right after the earnings event. But when I was looking at this thing, Matt, which again, to my point, doesn't exist anymore, hopefully some people took advantage of it. I certainly did not because I can't trade single stocks. But August was trading at the time at 59 vol. Back end was trading at 54 vol. So now that the stock is coming down somewhere around 260 area, it seems like volatility has contracted a bit across the board and certainly crashed in the very front month expiration. Matt, that will be my last one here. Let's wrap up. Market is catching a massive bid, which is great to see if you're bullish. Implied volatility is doing what, folks? Contracting substantially. I guess, Matt, once in a while, what do they say? Even a blind squirrel, right? Finds a nut. But the reality is, this is, if anyone knows this stat, you let me know. Apparently, squirrels cannot find 80% of the nuts that they bury. So are they really finding their own? Are they finding someone else's? I don't know. But the idea here, folks, is that sometimes you get a hunch, right? Sometimes you get a feeling, a tremor in the force, like my colleague Robert Kwan would say, and the markets do what they do. Take care, everybody. We'll see you soon. Hope you found it helpful.